Chevron Corporation, ticker symbol CVX, is currently trading at $147.33 a share. This is one of the largest integrated energy companies in the world involved in oil and natural gas exploration. It is one of the largest holdings in the Schwab US Dividend Equity ETF, otherwise known as SCHD. It is the 6th largest holding. So what we're going to be doing today is looking at my automated stock valuation spreadsheet, see if Chevron is a buy using the discounted free cash flow model, comparable company model, dividend discount model, and the Ben Graham formula for intrinsic value. So just quickly, as I said, it is one of the largest energy companies in the world. It has a diversified energy portfolio, both gas and oil. But one of the reasons this is popular with investors is its strong dividend yield, 4.43%, high, reliable dividend, backed by strong free cash flow, and has a history of consistent payouts. So if we go to my automated spreadsheet and put in the ticker CVX, this will load all the latest company financial data, and then we can have a deeper look. If you're interested in this, check my Patreon, but we'll talk about that more later. So, as I said, price $147 a share, 264 billion market cap, PE ratio of 16.12, which is much lower than the market average, which is around about 30. Earnings per share, $9.09, and a beta of 1.12, meaning it is more volatile than the market, so that's quite interesting. Analysts saying it is a buy, $175 a share, so massively discounted according to what analysts are saying. Quite interesting. Now, the dividend, as I said, 4.41%, but that means you get $6.49 a share. They pay out around about $11.7 billion in dividend. In terms of the payout ratio, 70%, quite safe. In terms of the trailing 12-month free cash flow payout ratio, 109%, but if we look historically, it was a safe dividend. If you want to get paid your quarterly dividend, buy before the 18th of February, and you will get paid. So let's have a look at revenues. These are revenues going back to 2009, trailing 12 months, 197.5 billion. So they had big years in 2022. They have been increasing since the pandemic year of 2020. Now that was a bit of a breakthrough year, but the general line is increasing, which is good. Net income, not a similar story here, 16.68 billion, down from 23 and 22. Free cash flow, 10.7 billion. This is decreasing over the last few years. Obviously, the pandemic year, it dropped down quite a bit. They were able to regain it, hit all-time highs, and has been kind of dropped off since then. But if we look at the operating cash flow, we can see here that operating cash flow has not decreased, which is good. It's just that the capex has increased, which then in turn has made the free cash flow decrease also. Shares outstanding, what they're doing? Well, they're buying back shares, rewarding shareholders through share buybacks, which is excellent to see. So let's have a look at the discounted free cash flow model. This is the way of valuing stocks at their future free cash flows and discounting them to today's value. Let me just update the weighted average cost of capital because we do have it there. Currently minus $21 a share, so obviously something's wrong here. Let's see if we're looking at the averages. Pardon me. We're expecting 218 and 240 billion in the coming years. Let's see if that is similar to what analysts are saying. 190. Oh, they're actually expecting declining revenues. Well, 197, 191. Bullish is 204, 211. So we'll have a look at both. So if they were declining at their current rate, which is 1.6, minus again. The reason for this here is the minus free cash flow ratio, but we'll look at that in a second. So if I just put in the net income margins, we'll take an average of the last few years. Pardon me. Is about 10%. Now what we'll do is we'll take an average of these last few years and ignore the 2021 where it was minus 300%, which puts us at about 63%. And there you go, immediately closer, $115 a share. So let's just have another look here. Let's take an average of these last 2 years. I think that's more of a realistic number, 80%. $147 a share, so puts it about fairly valued. Now this is with declining revenue. On the bullish case, sorry, where was it? Not sure my Patreon again, it was here. On the more bullish case from analysts, they're expecting growing revenue of 204 and 211 billion. So we'll just increase this to 3.5%, and that would make it a buy at $177, which is quite interestingly very close to what the analyst target price was. Next, we'll have a look at the dividend discount model. We'll decrease that to the discount rate, and then the average growth we'll put a bit lower. So they are, yeah, so if they were growing at about 4.5%, that would put them fairly valued. And as you can see, the average growth is a bit higher than that. So that's good to see in terms of the dividend discount model. Ben Graham formula for intrinsic value looks at earnings per share, PE on growth company, expected growth of obviously the company we're looking at, and the bond yield, which is currently 5.2%, which is increasing. So this is why this will like this a little less. I don't expect them growing at 30% over the coming years. Analysts are saying around about 9%, so I think this is not going to be a buy. 134, so not too bad. For this to be a buy, it would really need to be growing at around about, oops, let me withdraw that. On type, 12% would still be good. But yeah, about fairly valued on the Ben Graham formula. So finally, let's have a look at the comparable company model. This is a way of valuing companies, looking at competitors of similar industries and sizes. So initially, what I'm thinking of is if we put in the tickers here, it'll load all the company financial data so we can compare. And if you're interested in this, it's the $4 tier in my Patreon, the automated stock valuation spreadsheet. If you want to get me to do reviews for you as well, it's an extra, it's $7. Or if you just want to help me out, $1.50 a month, very appreciated. But I would prefer it if I'm giving you a service, and this sheet I do like. So if we put in Exxon, this will load up that. We'll do another one, COP, which is ConocoPhillips, and we'll do Oxy as well, which is a Buffett favorite, and we'll see. So in terms of enterprise value, Exxon is the largest. Revenue, Exxon is the largest. Revenue growth rate, we're not looking at Exxon, sorry, we are looking at Chevron here. Second largest, second lowest EBITDA, second highest net income, second most profitable. Profit margins, profit similar to Exxon, Conoco and Occidental are a lot higher. Price to sales, market average is around about 3.1, so all these are lower than the market average. Price to book as well, market average is about 5, these are a lot lower as well. Peg Peter Lynch's price to earnings growth, second lowest here, which is good obviously, but we do want this under 1, but in terms of their competitors it is the lowest. So EV to revenue, EV to EBITDA, PE and forward PE. Higher PE, lower forward PE, higher EV to EBITDA, and lower EV to revenue. So if we take an average of all these, it puts us at $154 a share. Now, if we were to compare against some bigger companies that I think are fair, which is BP and Shell, ticker BP, ticker symbol Shell. And interestingly enough, actually, it's less of a buy there because of the EV to revenues of BP and Shell are a lot lower. EV to EBITDA is as well. PE and 4P are lower. So it's actually, compared to these, it's not as much of a buy, which is quite interesting. But their most direct competitor, I would say, is Exxon. And if we were to compare them exactly, once again, fairly valued. So it is looking fairly valued against the competitors. But as I said, one of the reasons that people like this is for that 4.43% dividend yield. Right, guys, thanks for watching. Please give a like on the video if you enjoy it. Subscribe if you're not already, and I'll catch you guys next time.